Most traders don't fail because of the market. They fail because of how they think about the market. You can study strategies for years, memorize every pattern, every setup, every backtest. But when real money is on the line, something shifts. Your hands sweat, you hesitate, you chase, you freeze, you break your rules, and then you ask yourself, why did I do that? I knew better. That moment, right there, is the core of this video. Daniel Kahneman, Nobel Prize-winning psychologist and author of Thinking Fast and Slow, discovered something profound. We don't have just one way of thinking. We have two. One that's fast, automatic, and emotional, and another that's slow, deliberate, and logical. Most trading mistakes aren't due to bad strategy. They're due to the wrong system of thinking taking control at the wrong time. In this video, we're going to explore 10 of Kahneman's most powerful psychological lessons, adapted specifically for traders. Through each one, you'll see exactly how your mind plays tricks on you and how to train it to work with you, not against you. If you've ever felt like you're the biggest obstacle to your own trading success, you're right, but you're not alone. Let's break down what's really going on inside your brain and why the real enemy isn't the market, it's your untrained mind.
Part 1. System 1 versus System 2.
Imagine this. You're watching a chart. Price is moving fast. It just broke a level you've been watching. Without thinking, your finger clicks the buy button. Seconds later, it reverses. You panic, close out the trade, and feel the sting of regret. What just happened? That was System 1. Kahneman describes System 1 as the fast, intuitive, emotional part of your brain. It acts instantly, using shortcuts. It's great for survival, but dangerous in trading. This is the system that chases green candles, doubles down on losses, and gets paralyzed by fear. Then there's System 2, your slow, deliberate, rational self. It's the system that calculates risk-reward, follows your plan, sticks to process. But here's the catch. System 2 is lazy. It takes effort to activate, and when emotions run high, like during a trade, System 1 usually takes over before System 2 can catch up. Most traders lose not because they don't have a good strategy, but because they let System 1 trade for them. Think about your worst trades. Were they logical, or were they fast, emotional, reactive? To succeed, you need to create space between stimulus and action. That's where System 2 lives. Brett Steenbarger, a leading trading psychologist, teaches this too. He says, self-awareness is your edge. You have to train yourself to notice the shift when you're slipping into impulsive behavior and pause. How? Simple practices like journaling, self-talk, even deep breathing before entries can help interrupt System 1. Reviewing your trades daily builds System 2's muscle. Over time, this turns knee-jerk reactions into calculated responses. Trading isn't just about edge in the market, it's about edge in the mind. And it starts with knowing which system is making your decision.
Part 2. The illusion of understanding. You take a trade, it works perfectly. Right entry, strong move, easy profit. You feel sharp, like you've figured it out. But did you actually understand what happened? Or did your brain just create a story that made it feel like you did? Kahneman calls this the illusion of understanding. Our minds are story-making machines. We crave meaning. So when something happens, especially a win, we instantly explain it in a way that flatters us. I saw the pattern, we say. I trusted my gut. But the truth is, we often don't know why a trade worked. And that's dangerous, because that illusion builds overconfidence. You start thinking you're on a streak. You increase size. You break rules because you believe you're reading the market clearly now. But you're not trading better. You're just seeing patterns in hindsight and mistaking it for insight. This is one of the most costly psychological traps in trading. Great traders, like those coached by Brett Steenbarger, don't just celebrate wins. They dissect them. They ask, was this edge or luck? Did I follow process or just get away with it? When you win, don't assume you understand. Assume nothing. Review. Reverse engineer. Stay humble. Because if you let the illusion of understanding go unchecked, every win becomes a setup for a bigger fall.
Part 3. Loss aversion. Why does a $100 loss feel worse than a $100 gain feels good? That's not just emotion, it's loss aversion. And according to Kahneman, it's hardwired into the human brain. We are biologically designed to avoid losses more than we are motivated to seek gains. In fact, Kahneman's research shows that losses are felt at twice the intensity of gains. Now, think about how this plays out in trading. You're up $300 on the day. Then, one trade goes red, down $150. Instead of walking away with a solid profit, you feel compelled to make it back. So you force a trade, then another. Before you know it, you're negative. It's not logic driving that behavior. It's the emotional pressure of loss. This is why traders cut winners too early, locking in gains before they disappear, and why they hold on to losers, hoping they'll bounce back. Loss aversion hijacks your risk management. It makes you avoid pain, not manage probability. But here's the paradox. Trading success requires you to face losses directly and accept them. You can't avoid red days. They're part of the math. What matters is how you process them. This is where Brett Steenbarger's work becomes crucial. He teaches traders to reframe losses, not as failure, but as data. Each loss is tuition. It's payment for the lesson the market just gave you. One exercise. Every time you take a loss, ask yourself 3 things. Did I follow my process? Was the setup valid? What did I learn about the market or myself? If the answer to the first 2 is yes, then the loss isn't a mistake. It's a cost of doing business. Start thinking like a casino. They don't cry over individual losses. They play the long game. Every small, controlled loss is just another step toward positive expectancy. The weight of loss doesn't go away, but with awareness and structure, it no longer controls you. Trade to win, but learn to lose well. That's where consistency begins. Part 4. Anchoring. How past prices trick your mind. You buy a stock at $50. It drops to $45, then to $42, but you don't sell. You tell yourself, I'll wait until it gets back to $50. Why $50? Because it's your entry price. That number has become your anchor. Anchoring is a powerful cognitive bias. Kahneman explains it like this. Once our brain latches onto a specific number, especially one that feels important, it starts using that number as a reference point for all future decisions, even when it's completely irrelevant. In trading, this shows up in dangerous ways. You hold losers because you're anchored to break even. You hesitate to enter a great setup because it's not at the low you saw last week. You expect a move to go back to a previous high just because it once reached that level. But markets don't care where you entered. They don't care what the price used to be. Brett Steenbarger often reminds traders, the market is always fresh. Every moment is a new puzzle. Anchoring ties you to the past, and trading success comes from making decisions in the present. The fix? Stop asking, what was my entry? And start asking, what is the setup now? What is the current context? Would I still take this trade if I weren't already in it? Free yourself from the mental grip of old prices. Because anchoring doesn't protect your capital. It just traps your logic in the past. Part 5. The representativeness heuristic. You see a chart that looks just like the one from last week. Same breakout, same structure, same setup. You jump in, confident it'll do the same thing again. But this time, it fails. What happened? You fell into the representativeness heuristic, a shortcut your brain uses to judge probabilities based on how much something resembles a familiar pattern, rather than on actual statistical evidence. Kahneman explains it this way. We often mistake similarity for likelihood. If something looks like a past winner, we assume it will be a winner again. But in trading, what looks familiar doesn't guarantee the same outcome. The markets are not static. Context changes, volatility changes, news changes, liquidity changes, but the human brain is always hunting for repetition. It sees a pattern and instantly assumes the same result. This is why so many traders fall for last time this happened thinking. It feels logical, but it's often just emotional pattern matching dressed up as insight. To counter this bias, you need to switch from recognition to probability. Ask yourself, how often does this setup actually work in this market condition? What's the win rate and risk reward in the last 20 times I traded this? Am I trading the chart or the memory of a previous trade? Steenbarger teaches traders to build playbooks based on quantified setups, not just visual resemblance. That way, decisions are grounded in data, not deception. Because in trading, looking familiar doesn't mean acting predictable. Train yourself to stop seeing patterns and start seeing probabilities. Part 6. Overconfidence.
why you're not as in control as you think.
You have 3 green days in a row. You feel sharp, locked in, unstoppable. You start increasing size. Maybe you even skip your usual checklist. You're in the zone. But then one trade wipes out the last 3 wins. And suddenly you're confused. What just happened? That's the cost of overconfidence. Kahneman found that people consistently overestimate their abilities, especially in areas involving prediction and uncertainty. Sound familiar? That's trading in a nutshell. Overconfidence in trading shows up in subtle but deadly ways. You size up without real statistical backing. You ignore stop losses because you're sure this one will work. You trade more frequently because you feel on fire. But here's the truth. Confidence is not a signal. It's a feeling, and feelings are not facts. Kahneman explains that when people feel knowledgeable, they become less aware of what they don't know. In trading, that's catastrophic because markets are fluid, and the moment you think you have it figured out is often when you're most vulnerable. Brett Steenbarger warns about this too. He teaches traders to distinguish between earned confidence and emotional confidence. One comes from statistical process, the other comes from mood swings, wins, and ego. So how do you protect yourself? Start using confidence calibration. Before each trade, rate your confidence on a scale of 1 to 10, but pair it with evidence. What's your historical win rate on this setup? What does your journal say? Are market conditions favorable? If your confidence is high, but your data is weak, that's a red flag. You're not in control, you're guessing with conviction. Confidence feels good, but calibration builds longevity. In trading, the goal isn't to feel certain, it's to stay objective, because overconfidence doesn't just cloud judgment, it destroys accounts.
Part 7. The planning fallacy. When you first started trading, how long did you think it would take to become consistent? A few months? Maybe a year? That's the planning fallacy in action, Kahneman's term for our tendency to underestimate the time, effort, and complexity involved in achieving long-term goals. Traders often come in with unrealistic expectations. They think they'll be profitable after a course, a few books, or a demo account. But real trading mastery isn't just about knowledge, it's about transforming how you think under pressure. And that takes time, a lot more than most people expect. The planning fallacy creates frustration. You imagine smooth progress, and when the reality hits, drawdowns, setbacks, emotional spirals, you question your path. Some even quit. Not because they can't make it, but because they thought it would be easier. Kahneman warns, even experts fall for this. We know goals take time, but we still believe our journey will be different. That's the trap. Steenbarger flips this by helping traders see growth as nonlinear. It's not a straight line. It's more like plateaus followed by leaps. He teaches to measure progress not just by P&L, but by improvements in decision quality, emotional control, and discipline. To overcome the planning fallacy, stretch your timeline. Think in years, not weeks. Focus on process mastery, not fast profits. Embrace every mistake as material for refinement, not as failure. Trading is simple to start, but deep to master. And the moment you stop expecting it to be easy is the moment you free yourself to truly grow. Part 8. What you see is all there is. Wizziati. You look at a chart. Clean breakout. Strong volume. Price looks ready to fly. You enter without hesitation. Everything you can see lines up. But then, news drops. The market turns. Your trade collapses, and you're left wondering, how did I miss that? Daniel Kahneman calls this Wizziati. What you see is all there is. It's a mental blind spot where your brain makes decisions based only on the information immediately available, while completely ignoring what it doesn't see. And in trading, this can be deadly. You focus on the pattern, but ignore macro sentiment. You see momentum, but miss divergence. You analyze one chart, but forget to zoom out. The brain feels like it has enough data to make a confident choice, but often it's just reacting to a narrow slice of reality. Wizziati leads to oversimplification. It makes you trust shallow information and jump to conclusions because your brain hates uncertainty. It would rather complete the picture, even if it's incomplete, than admit, I don't know enough yet. This is why traders often say, it looked perfect until it didn't.
Brett Steenbarger teaches traders to build mental range, to deliberately consider opposing views before acting. One of his core principles: don't just confirm, challenge. To counter Wiziotti, use checklists that include external factors, broader market context, upcoming news, related sectors. Ask yourself, what am I not seeing? Or what would someone on the other side of this trade say? Never trade from a single data point. Build a thesis from multiple angles. Because in markets, what you don't see can hurt you far more than what you do. Train your mind to pause before you act. Broaden the lens. Seek what's missing. Clarity in trading doesn't come from seeing more, it comes from seeing more clearly.
Part 9. The halo effect. You take a trade that plays out perfectly. Clean entry, strong momentum, big profit. That win sticks in your mind. Now, every similar setup feels more trustworthy. You assume it's high probability because last time, it worked beautifully. That's the halo effect, Kahneman's term for how one positive outcome creates a glow that distorts our judgment. When something performs well once, we unconsciously project that success onto everything else that looks like it. In trading, this creates false confidence. You start to think, this stock always follows through. This setup is my best edge. This strategy is bulletproof. But that confidence isn't based on a large sample or deep statistical testing. It's based on one good experience or a small cluster of wins. And the danger? You stop evaluating setups on their own merit. You start assuming outcomes instead of analyzing probabilities. Brett Steenbarger warns against this emotional shortcut. He teaches traders to view each trade as independent, not connected to the last one. Just because the last flag breakout worked doesn't mean this one will. Context matters. Volatility shifts, news interferes, market mood evolves. To neutralize the halo effect, review trades in batches, 20, 50, 100, not just one or two. Log why a trade worked, not just that it worked. Ask, if this were the first time I saw this, would I still take it? Don't let one good trade blind you to future risk. Because the halo effect doesn't just exaggerate the past, it clouds your vision of what's really in front of you. Part 10. Intuition is only useful with experience. You hear traders say it all the time. I trust my gut. It just felt right. But here's the hard truth. Unless you've logged thousands of hours in structured, focused trading, your gut feeling is probably just emotion, not intuition. Kahneman is very clear on this. Intuition is only reliable in environments that are stable, repetitive, and where feedback is immediate, like chess or firefighting. But markets? Markets are dynamic, random, and often deceptive, which means most trading intuition is untrained impulse. New traders especially confuse adrenaline with instinct. You feel a rush when price breaks a level. You sense a setup forming. But what you're really experiencing is System 1 reacting fast, not System 2 thinking deeply. Real trading intuition, the kind that works, only comes after deep, repeated exposure to market behavior, combined with honest reflection. It's built over time by logging setups, reviewing outcomes, noticing patterns across hundreds of trades. Then, your brain starts to recognize structure subconsciously, not just react emotionally. Brett Steenbarger puts it simply, emotions are information, but only when they're trained. So, how do you build true trading intuition? Journal every trade, especially what you felt and why you acted. Track recurring setups and outcomes, not just winners, but how they behaved. Reflect regularly. Ask, did this instinct come from experience or excitement? Eventually, you'll notice a shift. You won't just act on gut, you'll act on grounded recognition. Because, in trading, intuition without experience is just a gamble in disguise. But intuition forged through experience? That's a powerful edge. You started this journey thinking the market was the challenge, but now you know. The real challenge is your own mind. Every bias we've explored, impulse-driven decisions, emotional reactions, overconfidence, loss aversion, they're not signs of weakness, they're signs of being human. And that's exactly why most traders struggle. Daniel Kahneman's Thinking Fast and Slow didn't give us trading strategies. It gave us something deeper, a blueprint for understanding how our own thinking works, and how it often works against us. When you understand the battle between System 1 and System 2, when you recognize that patterns can fool you, that intuition can lie, and that emotion distorts logic, you stop blaming the market and you start taking full responsibility for your decisions. That's where transformation begins. Brett Steenbarger always says, you don't trade the markets, you trade your psychology, because consistency isn't built on strategy alone.
It's built on self-awareness, on mastering the mental patterns that shape every click, every hold, every exit. So if you want to trade better, don't just study charts, study yourself. Go back to these 10 lessons, not once, not just today, but over and over, until they become part of how you see, think, and act. Because in the end, the most powerful edge in the market is a trained mind. And if you're willing to train it, the trades will follow.
If you found this helpful, hit like, subscribe, and tap the bell so you never miss a drop. Got thoughts or questions? Leave a comment below. I'm always checking in. Thanks for watching, and I'll see you in the next one. Check out this next video